So, you want to own Apple. Here's the problem before we even start. Every other business on this list, you could actually go buy the whole thing. An airport, a cemetery, a casino, a motel, somebody signs a deed and it's yours. Apple is worth $4.9 trillion as of July 2026. That's not a typo. That's more than the entire GDP of Japan, the world's fourth largest economy. Nobody, not a sovereign wealth fund, not a consortium of the 10 richest people alive, is writing that check. So the real question isn't how do you buy Apple? It's how much of it can you actually get your hands on, and what are you really buying when you do? Let's run the 3 realistic tiers. Option 1, you buy a single share. At current prices, that's around $290, which gets you a fractional claim on a company that shipped its best ever iPhone quarter in fiscal Q1 2026, $143.8 billion in revenue in 3 months alone. Option 2, you buy a real institutional position, the way Warren Buffett's Berkshire Hathaway did, at one point holding a stake worth over $150 billion, making it the single largest holding in Berkshire's entire portfolio for years. Even Buffett, one of the best capitalized investors on the planet, only ever owned a low single-digit percentage of the company. Option 3, you try to buy the whole thing outright. At a $4.9 trillion market cap, financing that purchase would require more capital than exists in nearly every sovereign wealth fund on Earth combined. This is a business you can only ever own a sliver of, no matter how rich you are. Now here's the part that actually matters. What are you buying a sliver of? On paper, you're buying a phone company. iPhone alone pulled in over $85 billion in a single quarter recently, still the largest single product line by far. But the phone business runs on a gross margin of around 37%, solid, but nothing special for a technology company. The real engine sits somewhere else entirely. Apple's services division, the App Store, iCloud, Apple Music, Apple TV Plus, AppleCare, now generates over $111 billion a year, about a quarter of total revenue. But it runs at a 75.6% gross margin, more than double the hardware business. That means every dollar of services revenue is worth almost $2 of iPhone revenue on the profit line. Despite being only about a quarter of total sales, services now contributes roughly 41% of Apple's entire gross profit. You didn't buy a phone company. You bought a subscription and toll collection business that happens to ship phones as the entry ticket. And the toll itself is the cleanest part of the machine. Every time a developer sells a digital good or subscription through the App Store, Apple takes a commission of up to 30%. With over 2.5 billion active devices in the installed base worldwide, that's not a one-time sale. It's a permanent tax on an entire economy of apps that only exist because people already own an iPhone. You don't build the game. You don't write the app. You don't process a single customer support ticket. You just own the only road into the walled garden and collect a cut of everything that travels down it. Except that toll booth is currently on fire, legally speaking. Epic Games, the maker of Fortnite, has been suing Apple since 2020 over exactly this commission. A judge ruled back in 2021 that Apple wasn't a monopolist under federal law, but did find Apple violated California's unfair competition law by blocking developers from telling users about cheaper ways to pay. Apple complied by allowing links to external payment options, then quietly imposed a new commission as high as 27% on any purchase made within 7 days of clicking one of those links. In 2025, the court found Apple in civil contempt for willfully defeating the spirit of its own injunction, and as of mid-2026, Apple is currently charging 0 commission on those external links, while the fight over what a reasonable rate should be heads all the way to the U.S. Supreme Court. Depending on how that case lands, a meaningful slice of Apple's highest margin revenue stream, could simply be regulated out of existence. There's a second legal fight that shows how the same trick works internationally. For over a decade, Apple ran its European profits through an Irish subsidiary structure that got its effective tax rate down to something like 0.005% in some years. The European Commission ruled in 2016 that this amounted to illegal state aid from Ireland, ordering Apple to pay back taxes. Apple fought it all the way up, and in Hajj on September 2024, the EU's top court delivered a final, unappealable ruling. Apple owed 13 billion euros, over $14 billion, plus interest in back taxes. The money had been sitting in an escrow account since 2018, waiting for exactly this outcome. It's one of the largest corporate tax recoveries in history, and it happened to the most valuable company on the planet, precisely because being that valuable means every jurisdiction on Earth eventually comes looking for its share. There's a third fight running in parallel, and it's the biggest one. In March 2024, the Department of Justice, alongside 16 states, sued Apple directly for illegally monopolizing the US smartphone market, a market where Apple controls more than 65% of sales. The complaint reads almost like a list of small, individually defensible decisions that add up to something much bigger. Limiting non-Apple smartwatches, restricting cross-platform messaging so a green bubble never looks as good as a blue one, blocking cloud gaming apps that would let people play console-quality games without ever buying Apple hardware, and capping third-party digital wallets. In June 2025, a federal judge in New Jersey refused to dismiss the case, letting it proceed to full litigation. And in July 2026, Bloomberg reported that Apple and the DOJ have quietly entered early settlement talks, trading draft agreements back and forth, following Apple's own recent moves to open the iPhone up to cloud gaming, RCS messaging, and outside digital wallets, changes that look suspiciously like Apple pre-negotiating the outcome before a judge forces it on them. Here's the revenue stream almost nobody frames correctly, because it isn't really revenue at all. It's what Apple does with the revenue once it's collected. Apple generates so much free cash flow that its single biggest use of money isn't research, isn't acquisitions. It's buying its own stock back off the market. Between fiscal 2021 and fiscal 2025, Apple returned roughly $522 billion to shareholders through dividends and buybacks. Nearly 97% of everything the company generated in free cash over that stretch. In just the December 2025 quarter alone, Apple returned around $32 billion to shareholders through dividends and repurchases combined. And in the following quarter, the board approved yet another $100 billion buyback authorization on top of that. Every share Apple retires increases the percentage of the company owned by everyone still holding stock without them buying a single additional share. It's a machine that quietly compounds your ownership stake for you, funded entirely by other shareholders selling out. Now, the cost side. Because none of this happens for free. Apple spends over $10 billion a quarter on research and development, plus billions more every year in capital expenditure, on data centers, custom silicon design, and retail stores. But the far bigger, far less visible cost is the physical supply chain, most of it in China, running through contract manufacturers like Foxconn, who assemble the overwhelming majority of iPhones at a handful of enormous facilities that can each employ well over 100,000 workers during peak production season ahead of a new launch. Apple doesn't own those factories, which keeps its own balance sheet light and its capital expenditure remarkably low for a company this size. But it also means Apple's entire production capacity sits inside one country's regulatory, labor, tariff, and political environment. In 2026, Apple has reportedly opened early talks with Intel and Samsung about diversifying chip production away from near-total reliance on a single supplier, TSMC, A sign of exactly how uncomfortable that concentration has become, even for a company sitting on more cash than most national treasuries. And that's the actual risk sitting underneath the trillion-dollar number. A storage facility risks a competitor building across the street. Apple risks something bigger. 3 separate legal systems are simultaneously attacking the specific mechanics that make it worth $4.9 trillion. The App Store Commission, the highest margin revenue Apple has, is currently being litigated down to 0 on a growing share of transactions in the Epic case. The DOJ's monopolization suit is targeting the exact ecosystem, lock-in, messaging, wallets, watches, cloud gaming, that keeps 2.5 billion devices from ever switching platforms. And Europe has already forced Apple, under its Digital Markets Act, to allow sideloading and alternative app stores on iPhones sold in the EU, a preview of what US regulators may eventually demand too. Meanwhile, the manufacturing base that builds the physical product, generating 3/4 of revenue, sits almost entirely inside one country Apple doesn't control and increasingly wants to hedge against. Take away the toll booth's pricing power, or force the ecosystem open, or lose a manufacturing hub to a tariff dispute, and the multiple investors are willing to pay for this stock changes overnight. Time to pull it together and answer the actual question. What do you actually make owning a piece of this? 3 scenarios, real numbers. Option 1, you buy $10,000 of Apple stock, roughly 34 shares at current prices. You collect a small quarterly dividend, currently yielding under 0.5%, basically nothing on its own. But your real return doesn't come from the dividend. It comes from Apple retiring shares faster than almost any company in history, which has helped compound earnings per share by an estimated 2.5 to 3% a year on buybacks alone, layered on top of whatever the underlying business actually grows. Over 5 years, that combination is the entire investment thesis in miniature. A slow-moving hardware business subsidizing an aggressive permanent reduction in the number of people it has to share its profits with. Option 2. You build a serious institutional position, $1 billion, which at today's market cap buys you roughly 0.02% of the entire company. Sounds tiny, but at Apple's scale, that stake alone would have been worth noticeably more just a year earlier, given the stock's roughly 56% rise over the preceding 12 months. And it entitles you to a seat, proportionally, at the table for a quarterly capital return program running into the tens of billions of dollars, the exact position Berkshire Hathaway held for years before trimming it down, at one point owning a stake worth well over $150 billion and still never crossing a low single-digit percentage of the company. Option 3. You don't try to own equity at all. You try to insert yourself into the toll booth the way Apple itself does to developers, building something inside the ecosystem, an app, an accessory, a service that collects a small piece of that 2.5 billion device installed base every single day. The same way Apple collects its cut from you, accepting in advance that whatever percentage Apple lets you keep can be renegotiated by Apple, a court, or a regulator at any time, with essentially no notice, because that's what this business actually is, not a phone company. A toll booth built on top of a phone, with a toll booth currently worth more than the road, and 3 different legal systems right now arguing about who actually gets to own the toll.